Okay, now the class has been recorded. Now let's start. And we are gonna tackle example 3, the one of in page 224, whereby there is area preference dividend, and then they are now being paid, like since from whatever year to now they have been paid. So let's see how we're gonna tackle that kind of question. I'm opening my Excel so that we can see how we do the question. So you will tell me when you see my Excel. Sharing it now, just hold on. Excel. Please tell me if you see my Excel.
We see it.
Okay, now let's resume. Example 3. Example 3. Oh gosh, where is this thing typing? Example 3. Preference shares. Yes, now are paid. So in this case, if you read this example, we are given the pre-abridged statement of financial position and the balance sheet together with statement of profit and loss. We are given the statement change in equity in page 226. Then we are given the adjustment. So now let's read the adjustment on page 227. They say on W Limited acquired its interest in V Limited on 1 March 2005, at which date the other components of equity were as follows. I would request someone to mute Dakalani. Okay, thank you. Then at which date the other components of equity were as follows. We have the revaluation surplus of 20,000 on W Limited and dash on V, retained earnings of 19,000 and 8.6 on V. Then they say each share carries 1 vote. Consider the carrying amount of the assets and the liabilities of V Limited equal to the fair value thereof on the date of acquisition. Then on transaction number 2, on 1 March 2005, which is from the date we acquired the interest, no preference dividends were in arrears. So on that day, there was no preference shares in arrears. All preference dividends since 1 March 2005 were paid on 28 February 2007. Then number 3, the land of V were revalued on 31 January 2006. Number 4, on 28 February 2007, V Limited declared a dividend of 10 cents per ordinary shares. W Limited recorded this receivable dividend. Then on 28 February 2007, there was no area interest on debenture. So before I tackle this, let's do the smaller timeline. So on our timeline, we have the acquisition date, which is 103 20.5. Then we are given that the preference shares the preference shares, welcome Glen Rose. Then the preference shares were paid on 1 March. Were paid on 28 February. Paid on 28.02/2025. Then in this case, it means on the period starting on 1 March 103 20.5 to to 28.02, 20.6. No dividends were paid. No dividends were paid. It means this portion, it was in arrears. It was in arrears. Then the portion from 1.03, 20.6 to 28.02, 20.7 is the day we pay. Payment was effected. Then this will make it green. So since the dividend were paid here, so it means we also have to account for the one which they were not paid for the prior year. So this is the date of acquisition, and then from 1 March 2005 to 28 February 2006, it will fall from since acquisition to the beginning of the current year. Then this will be current year. So this will be current. This will be since acquisition to beginning of current. BGN. And then this is the acquisition date. Then we can start with our analysis. So it will have a total here. It will have the since. It will have the NCI. Let me check from you. Since I requested that you can do this exercise and not jot down the things that you didn't understand, did you try to do this exercise? Feedback? Takalani? Just be honest.
I was not in class, so like when I was trying to play the video, the recorded video, and then I saw your introduction, you were like you were going to do cash flow today, and then I decided to prepare cash flow.
Okay, it's fine. It's just the smaller, and that's why I don't want to dwell much on this exercise, so we can focus on the cash flow. Mudise?
I have to be honest, I haven't tried.
Mary?
I've tried, sir.
Okay, and then did you jot down things that you didn't understand?
Yeah.
Okay, Tandaka?
No, I didn't. I only did the first part, the analysis of owner's equity, and
Yeah.
it was fine.
Okay, and Glenn?
No, sir. Morning. No, I didn't.
Okay, so I'm gonna only do the part of analysis, and the smaller part, yeah, the journal, and the smaller part, yeah, profit before tax. Then the rest to just be the copy and paste, so that we can move forward to the cash flows thing. So on the analysis, we've got the one. This one is for the ordinary shares. The ordinary. So we have the share capital. The share capital. Which it will be the 200,000. And then we add acquisition, because based on the interest, this person is owning 70% interest. And then this side will be the dirty part. So the 70% of the 200 is 140. Oh, sorry, I'm writing on the wrong column. We should have the add acquisition here. Add. So it's 140. And then the NCI, it will be the 60. And then we've got the retained earnings. Retained earnings will be 8600. And on the add of acquisition, it will be 6020. Then here the balance will be 2580. Then we do our totals, which they will give us the, hold on. The top. They give us the 146,020, and then the investment part or the cash consideration. Cash consideration sitting on, we paid 150,000. So out of the 150, when less this, then we're gonna have a goodwill. Goodwill. So the goodwill is sitting on the 3980. Then we go to the since acquisition part. Acquisition to beginning of current year. So the since acquisition, we're gonna have to calculate the retained earnings. Retained earnings, where we have a given value. Our given value is sitting as we had the acquisition of 8.6, but when we check the retained earnings from the statement of changes in equity for V Limited on page 226 is sitting on 17.8. So we're gonna say 17,800 we less the one-off at acquisition of 8.6. Then we are left with an amount of 9,200. Then now our thingy, our profit that we have is sitting on 9,200, but the preference shares that we need to declare, which we acquired the preference shares of 100,000 preference shares at 12%. So when we say 100,000 multiplied by 12%, it says we must get 12,000. So the 12,000 is the one to be paid, but there is no enough profit. So it means we can clearly say these are the area preference dividends. That's why I indicated that they were not paid here. No dividends were paid. So it will be the area preference. Preference dividend. So our area preference dividend, sorry, this should come cut, paste, set, yeah. So our area preference dividend, since it's 12,000, but there is no profit to be utilized. So when you say 9.2 positive and 12,000 negative, they're gonna give you the retained earnings of 2,800 minus. So it means now it's no longer accumulated profits, it will be an accumulated loss. And then the 2.8, when you apportion it according to the since acquisition, it will sit on 1960 minus, and then the difference of minus 840. Then we go to the current year. On the current year, we check from the W Limited. W Limited, he had a profit of 68,600 as shown in the statement of changes in equity on page 226. So the profit for the year, is sitting on 68,600 and 68,600. So it means this guy is now having a profit. So at 70%, he will have a 48,020 and 2580. Okay, before here I forgot to put the revaluation surplus of the current year. Is the revaluation and surplus. Revaluation surplus, which is based on the now revalued the thing from or during the current year. They say on the land of B Limited were revalued on 31 January 2006. So when it was being revalued on 31 January 2006, the revaluation surplus as seen on statement of change in equity page 226 is now 15,000. So the revaluation surplus here will be 15,000. Then when we are pushing according to the percentages, 10,500 and the remaining balance of 4.5. So on the current year, now we have a profit, and then we know that our dividend is 100,000 multiplied by 12%. So the which now, because we are having a profit, we're gonna pay them here. So the payment, it will be the preference dividends, which it will be the 100,000 multiplied by 12%, which is sitting on the 12,000. So since we have enough profit, we can pay. Then the apportionment, and then the last 30%. Then the guy also had the ordinary dividend to declare. Like if you can check on example, I mean on adjustment number 4, they say on 28 February 2007, V Limited declared a dividend of 10 cents per ordinary share. So it means he also have a dividend of ordinary dividend here, ordinary dividend at 10 cents. So he issued how many shares? He managed to issue 100,000 shares as seen from the statement of financial position on page 224. Is 100,000 shares. So you're gonna say 100,000 shares, not value, because the value is 200,000. But in terms of the shares, you're just gonna say 100,000 shares. You multiply by 0.10 because 10 cents is represented by 0.10, which it's gonna be 10,000. So it means here to be minus 10,000. And then here, the balance, which it will be the 7,000 and 3,000. So then when we check, we're gonna go to the one for the ordinary, I mean the preference shares. So here it will be the totals. So the totals to be Here to see that 271,380, and then it will be the total of they just are pushing them according to the RE versus the OCE. But the total would be 3660 plus 10,500, which it will be the 41,160. And then this side it will be 80,220. Then we go further, we do the one for the preference shares, analysis shareholders for the preference shares, which is where we're gonna show this part, these transactions of the area preference dividend and while now they're getting paid. Preference shares. It's gonna have the total. Add since CI. Then we have share capital. So on the share capital, he issued 100,000 preference shares, as seen on page 224. They said the 100,000 12% cumulative preference shares, their value is 100,000. So we say 100,000 here, and then we add acquisition because they are now at 10%. This one is 10%, while the remaining that side it will be 90%. It means in this case, parent is only acquired the 10% of the preference shares issued by V Limited. So it will be 10,000. And then the NCI part, it will be 90,000. Then we go further. We have the goodwill, because he managed to, the total here, it's gonna sit as 10,000. And he managed to pay 12,500. Consideration paid by parent company. 12,000. So it means there is a goodwill here. Goodwill is sitting at 2.5. Now we are trying to record this transaction, this one, on our analysis of shareholders for the analysis shareholders for the preference shares. So now it's gonna have the since acquisition. So on the since acquisition, we will have a preference dividend. So this one is the one which they were not paid. Because we had the area preference dividend. So this area preference dividend, this one, this portion, it need to be affected down there because it was not paid, which is also represented by the red side, the one which were not paid. So the amount which is not paid is going to be transferred down there, which will be the area preference dividend. So we say preference dividend, we didn't pay an amount of 12,000. So we put that 12,000 here. So we say 12,000. And then when you apportion it, the 12,000 times the 10%, it's going to give us the 1.2. And the remaining balance, it will be the 10,800. So these are the one not paid in the prior year. Not paid in the prior year to unavailability of profits, because there was no enough profits to pay this dividend. So on the current year, we're gonna record the one paid. So the one paid is this. This was paid. And they were paid from what? From the profit. So when we record them, we're not gonna call them preference dividends. We record them as the profit attributable to the preference owners because they are now paid. So preference profit attributable to preference owners. The profit attributable to the preference owners is the 12,000. This one, the one which is now paid due to the available profit. It's 12,000. And then we apportion it the way is 1.2 and the 10.8. This one they are paid as a result of available profits. Then now we're gonna say area preference dividend paid. So area preference dividend paid. So the area preference dividend paid, it will be, because now we have to go back to our information whereby they will say transaction number 2 on 1 March 2005, no preference dividends were in areas. So when we start our year on 1 March, there was no area preference dividend. So the area happened on period 1 March 2005 to 28 February 2006, which is this period. This was the area preference dividends of 12,000. The area preference dividend of 12,000, this one. So now, since this one was not paid, and then we're gonna also add it together with this one, the one which they are now paid in the current year. So here we're gonna say area preference dividends. So it will be the 12,000 of 20, the 12,000 of 2006 year, or 20.6 financial year, and the 12,000 of 12,000 for 20.7 financial year, the one which is now paid from the profit. So when we add the two together, they're gonna give us 24,000. So we're gonna record this 24,000 as area preference dividend, even though now they are paid. So we say area preference dividend paid. Area preference dividend paid. If you can check the one in the prior example, especially on page on page 214, the one of the preference dividend, it was only for 1 year because they were on the prior year, they were being paid frequently. It was only the current year which it was paid from the profit. So we only recorded once here because there were no prior preference dividend not paid. But in this case, we have the preference dividends which they were not paid in the prior year. So we have to add them, the one of the prior year not paid. So it will be the current year plus the prior year not paid. Then we call them all together area preference dividend paid, which it will be 24,000. 24,000 as minus, because it's now paid. Minus 24,000. Then we minus the percentage of the difference, which it will be the 2.4. And then we minus the percentage of 21,600. So this is based on what paid so far. Which is the combination of the area not paid plus the current year paid. So now, because we all of them we have an available profit, because our profit was 16 on 68,000. So if you say 68,600, you minus the 12,000 for the current year, and you also minus the 12,000 of the prior year, we still have enough profits to pay the ordinary shareholders, because the ordinary shareholders, they will be paid from the profit of, we'll say 68,600, we minus 24,000, which is the 12,000 for the current plus the 12,000 of the prior year. Then we are left with 44,600. So out of the 44,600, we also pay the ordinary dividends of 10,000. So we are left with 34,600. So this one is the area preference dividend paid. Paid from available profits. So, is there anyone who doesn't understand up to so far? Especially the yellow part. Glenn?
Hi, meneer.
Are you fine up to so far?
A little bit.
We want the final answer. We don't want the little bit. Because in the exam, you can say, I don't understand the question little bit. You have to write what you understand and we mark it.
No, I am a bit confused because
Okay. Elaborate where are you confused so that we can clear that confusion.
okay, so far I was still trying to catch up. So it's like the entire lesson I've been trying to catch up. But then I do understand what you are doing right now. And then I went to the requirements, the additional information to understand the current year profit attributable to preferred owners. And then the part of the minus, which is the area's preference dividend, I wouldn't understand it really.
So you don't understand this. You don't understand this one.
Yeah, is point number 4, where it says VLTD declared a dividend of 10 cents per ordinary share.
That one doesn't affect anything to do with the preference shares.
Point number 1.
So you want to know which point represent the yellow one.
Yes.
Oh, the yellow one is represented by point number. Let me go back to my thing. The point number 2 is the one which causes this thing, because they say on 1 March 2005. So let me go back to here. Today is 1 March, right?
Yes.
Which is today, the day I'm acquiring the interest of this person. On 1 March 2005, there were no preference dividends in arrears. So it means every preference dividend is paid up to today, right? You are happy there?
Yes.
Now they continue. All preference dividends since 1 March 2005 were paid on 28 February 2007. So when you gauge, here's the date of acquisition. They say no preference dividend is in area. Now they tell you that from the date we acquired, until the end of the year, the preference dividends, they were not paid, or they were only paid on 28 February 2007. Meaning in 2006, no dividends was paid. So that's why I said on 1 March 2005 to 28 February 2006, no dividends was paid. You are happy there?
Yes.
It means the dividends are in arrears, right? And then we come back, we say on 1 March 2006 to 28 February 2007, now is where the dividends will be paid.
Okay.
Which they will be paid on 28 February 2007.
Okay.
So when the dividends are paid on 28 February 2007, in terms of this question, we assume that all these preference shares, they are cumulative, even though they didn't mention anything. But in terms of this question, you see, they mention it's 100,000, 12% cumulative. So it means if you don't pay the dividend, you still have to pay it in the later years. The time that you are declaring the dividend, you still have to pay the one which you didn't pay in the prior years.
Yes.
Makes sense there.
Yes.
So we didn't pay the dividends in 28 February 2006. So when we pay on the 28 February 2007, we also have to account the one we didn't pay on 28 February 2006. That's why now we end up coming with this 24,000. So 24,000 comes as a result of paying the current year and also paying the last year.
Okay, I'm with you now.
Okay.
Thank you very much, sir.
All right. Tandega.
I'm good, Mr. Molepo. My confusion came a little bit with the ordinary dividend, I think.
The ordinary dividend. The ordinary dividend there up there.
Yeah.
This one. So the ordinary dividend only affect the ordinary shareholders. It doesn't affect anything to do with preference.
With preference shares, yes.
Yeah.
So I think what confused me, but I think I need to redo Unit 8, was that I've always associated the ordinary dividend with the current account that was always very visible in Unit number 8, which now, yeah, that's where my confusion
came. No, the current account is separate. It's something else.
Yeah.
Yeah.
Understood.
I remember even on the time we're doing linear number 8, we were confused by this current account thing. They are not associated with ordinary dividends. Yes.
Okay. All right.
Okay.
And then in the case of the declaration of the ordinary dividend, right? So what I want to understand is this: would it have been declared if there wasn't enough profit?
Okay. Suppose there is not enough profit, the ordinary dividend will also not be declared. We only declare them if there's enough profit. Let's twist the question. Let's say my profit is now sitting on, let's say it's sitting on 25,600.
Yes.
I'm just twisting the question now. It's 25,600 here, ne? So since it's 25,600, I can pay the 12,000 for the ordinary dividend. I mean, for the preference dividend the prior year, right? And I can also pay another 12,000 for the current year. So if I say 25,600, I less 12,000 for the prior year, I'm left with 13,600, right? And then I less another 12,000 for the current year. Then I'm gonna left with 1.6. So since now I'm left with 1.6, I don't have enough profit to declare the ordinary dividend. So it means in my case, our ordinary dividend was gonna be dash. And remember, with ordinary dividends, they are not cumulative. If we didn't declare, then we'll focus on the next year.
Okay. Yeah. Understood.
Okay.
Thank you.
And I think that question was very important for others, which they didn't understand with the portion of the ordinary dividend. Now they have a clear understanding that with ordinary dividend, you also declare them if there is enough profit. If the profit is not enough, you can't declare them, because the minute you declare them, you're gonna live with a minus. So, and we don't want to have a situation where we have an accumulated loss. We want to try by all means to have accumulated profit. Mulise,
I think I'm okay. I'm okay, thanks.
Mary,
Now I'm okay, sir. Remember at the beginning I said I had questions.
okay.
So now that you have explained, I understand more, especially under the analysis of owner's equity, the preference shares, the
Okay.
24,000. I couldn't understand that, but now that you have explained, I understand it.
It came as a result of adding the current which was paid plus the prior year which was paid. And remember, we paid the current because there was enough profit. Suppose
Yes.
our profit was not enough, we were gonna only pay the one for the prior year.
Yes.
Okay, the
Okay.
last one, which is Takalani. Takalani.
Yes, I've been very, very much lost. But with the question, the colleagues are asking, like, yeah, I'm getting some clearance. So for me, I think I'll go through the video again.
Okay, no problem.
Yes.
All right. So with regard to the analysis for preference is fine. Now most of the people they understand. If you don't understand, feel free. You can send a message and say, okay, I was threatening this question, and then I didn't understand where did they get this 12,000 or whatever amount which it may be. Then I will try to check it, and then I will elaborate it to you so we can proceed further. So now we have to do our thingy. We have to do our consolidations. So with regard to the consolidations, I'm not gonna dwell much more. I'm gonna just tackle the profit before tax calculation. I'm gonna also tackle what else need to be checked. I think the journal number. Okay, please name your journal. The journal of the first journal, the one for share capital will be J1. And then the journal for non-controlling interest and the retained earnings of 840 will be J2. Then the journal for 4,500 will be J3, the one for revaluation surplus. Then the journal for share capital, goodwill, investment in V Limited, the non-controlling interest of 90,000 will be J4. The journal for retained earnings of 10.8 is J5. The journal for 16,980 for non-controlling interest is J6. The journal for dividend, J7. The journal for non-controlling interest of 10.8 and the non-controlling interest on SFP is J8. The dividend received on page 233, 2.4 to 21,600, it will be J9. The debentures, J10. The dividends payable by V Limited and a loan account is J11. The loan account again of V Limited and W is J12. And the interest received on debentures is J13. So I'm gonna do journal. The journal 2 is fine. Journal 3 from the 4.5 is also fine. The J4 is fine. J5, 10.8. From the analysis of the share ordinarily, I'm not the preference shares is fine. I'm gonna do J6 and I also do J7 and I do J9. And then after J9, I do J10 is just straightforward. J11, dividend payable. Also the J11, I will do it. And then the J12 is the loan account of the group. The loan account of 21,000. Then the loan, so they minus it by 7,000 is fine. And then yeah, so now let's check let's start with the journals first. The J number 6, the non-controlling interest of 16,980. If you check on your analysis shareholders, we have on the current year, we had a profit of okay, remember here we did our thing. The profit here should sit on 68,600. We had a profit of 68,600. So on this profit of 68,600, we have to less the preference dividend paid on the current year. So we say 68.6 minus 12,000. So we're gonna be left with 68,600 minus 12,000. We're gonna be left with 56.6. So out of the 56.6, it's multiplied by the 30%. The 30% is from this portion because we want to have the non-controlling. So it means our non-controlling is done after we say, just hold on, okay. It will be done after we say that 20,580 minus the 3.6. So this, they will represent our non-controlling interest. In the shorter calculation, in the long calculation, it means you say 68.6 minus 12,000, then multiply by the 30%. Then it will give you that portion of 16,980. So that represents the non-controlling interest. So non-controlling interest in the SCI versus the non-controlling in the who is this? In the SFP, it will come from this 20,580 minus 3.6. Then the J7. Now you see on the J7 they say dividend received by W Limited. So W Limited own 70% shares here. There are 70% shares which is they are owned by W Limited. So on that 70%, this 7,000 is the one that comes from. You see, dividend received by W Limited is 7,000. So the dividend which they're gonna go to non-controlling, it will be this 3,000. So the 7,000 is the dividend received by W Limited. The 3,000 is the dividend received by non-controlling interest. So the ordinary dividend declared by V is the total of 10,000. Are we clear also? Silent means everyone is fine. Then the J number 9. The J number 9, the dividend received by W Limited. So W Limited received the dividend from here. He received a dividend of the 2,400, this one. Was we declared the preference dividends, and then W Limited only owned 10% of the preference shares of V. So since V declaring the dividend, so W is entitled to 2.4. So that will be the 2.4 of dividend received in respect of the preference shares is 2.4. So the non-controlling interest paid, or it will be the 21,600, this one. And then the total dividend, preference dividend paid is 24,000. Then J number 11, dividend payable. The dividend payable of the 7,000, it goes back to the same question here. It goes back here. The dividend payable is 7,000. Now they want to use the dividend paid by W Limited to V. to settle the loan. Because if you can check from the page 224, we have loan to W Limited, which is 28,000, and we have a loan to V Limited of 21,000. So this loan, they must end up being equal. So in this case, V Limited have a loan of 28,000, which he acquired from W. I mean, V have a loan of 28,000 acquired from W, and then V, he now pay the dividend, which he must pay the dividend of 7,000 to W. So instead of giving W the amount of 7,000 as the dividend, he say, instead of giving this 7,000, I want to reduce the loan account I have with you. Since I have a loan account of 28,000, I want to pay this dividend as a part of payment towards the loan I have with you, so that my loan is no longer sitting on 28,000. Instead, it's gonna sit on 21,000. So that 7,000 reduce the loan account from 28 to 21. So it means both of them, they can now have the loan towards each other of 21,000. V Limited, we have a loan in W Limited of 21,000, and W Limited, we have a loan with V Limited of 21,000. If you can check on the equity section, we have a loan account of V Limited is 21,000, but on the asset section, we have a loan account of W Limited 28,000. Is it clear, that portion where we're using the dividend to reduce the loan account towards each other? Tandeka, this it will trigger you again. It also goes hand in hand with that one of the current account where they were declaring the dividend in order to reduce the current account.
Okay, noted.
Okay, Glenn.
I mean, I wanted to ask something. On the journal number 7, only the
Journal number 7, okay. Journal number 7, yes.
Only the non-controlling interest is in bracket. So how does it balance? Because on the credit side you have 10,000, and on the debit side you have 7,000 and the 3,000.
Remember, the non-controlling interest is not our column. It's not the journal. This is just to show how much non-controlling interest they have an effect. So the journal, our journal is debit and credit. So if you check the debit and the credit, they balance. 7,000 plus 3,000, they equals 10,000 on the credit.
And there's a 3,000 that you've got a C.
Yeah, that 3,000 with a C is just for elaboration purposes. You're gonna use the 3,000 for C when you'll be doing your things. Either you're doing the one of the statements, yes. When you are doing the statement of change in equity, you're gonna use that 3,000. You see, when you check the dividend declared ordinary, 3,000 C.
Yes, I see it.
Yeah, so the amount shown in the NCI column is for you to use them when you will be doing the non-controlling interest in the statement of profit and loss, or in the statement of changes in equity, or in the statement of financial position.
Okay, I'm with you. Thanks, Minnie.
If you can see, the 3,000 is sitting with the line of non-controlling interest. Again, if you check the 10.8, they say non-controlling interest SFP is 10.8. So it's they only use the amount in line with non-controlling interest only.
Understood, Minnie. Thank you.
All right. And then Mulise.
I'm good, sir. Thanks.
Takalani.
I'm good, thank you.
Okay, that was journal number 9, the one of using the dividend towards the loans. I mean, it was journal number 11. Then up to so far, there is no other journal which I can elaborate. The other journal, they're just straightforward, since we have been doing the same journals from learning number 1 until today. So it's just the straightforward journals. Then I'm gonna do the profit before tax. The profit before tax of W Limited is given as 29,600. Check it from the page check it from the page 225, the 9,600 given, 106,000 for V limited is also given. Then we have an ordinary dividend declared by V. From the analysis of shareholders on page 230, the dividend declared by V towards W is 7,000. W limited received a dividend of 7,000. So this dividend 7,000, he accounted them to show if he was not accounted them, we were not gonna record them, we were not gonna deduct them. But to show that he was already accounted them, check the statement on page 227, adjustment number 4. They say on 28 February 2007, V Limited declared a dividend of 10 cents per share on the ordinary shares, and W Limited recorded this receivable dividend. So W Limited had already recorded it. So since he recorded it, we have to deduct it because it's an intercompany dividends because they were declared by V and recorded by W. But if W was not recorded them, we were not going to include them here. That's 7,000. I guess it's making sense. Then the preference dividend paid by V Limited. We paid the dividend of V Limited, which the dividend paid initially it was 12,000. So the 12,000 multiplied by 12% times 2, then multiplied by 10%, because the 10% we are using is the one for on the analysis of shareholders of preference shares. If you can check, the 2.4 that they are recording is the one on the minus. You see the area preference dividend paid, because since they are now paid, it means V Limited received them. So since V Limited received them, we must deduct them also. So the 2.4, the one on the minus on the analysis, that 2.4 is the one that we're going to deduct on the statement of profit and loss under the profit before tax. And the interest on debentures of the interest on debentures 400 positive is the intercompany things, which they come from on the date for 2007, there was no area interest on debentures. So they come from our statement of financial position, whereby they say the dividend, the debentures, they issued the debentures of 10,000 rand. So the interest on debenture from the asset section, they say 10% times the debenture, which the cost price of the debenture was 4,000. So when you say 4,000 times the 10%, it's going to give it the 400. So the 400 will be the interest to be paid by by V Limited, while W Limited will receive the interest of 400. So it's an intercompany thing. We're going to deduct it so that we are doing the elimination. It's the same as the one shown in the journal on the last journal number 13. Interest received on debentures by W Limited versus the interest paid on debenture by V Limited. So the 400 rand is the one for elimination on the intra-group debentures. Anyone who have a question up to so far with regard to this example 3 before we jump to the next section of cash flow?
Okay, so I have a question.
Mary?
If we look at our consolidated statement of financial position, page 228, I wanted to ask about under equity and liabilities. I wanted to ask about other components of equity. If you can explain to me, how did they get that amount?
The 30,500.
Yeah.
The 30,500, it came as a result of the revaluation surplus. Check the statement of change in equity. There's a revaluation surplus of 30,500. Remember, did you do FAC2601, right?
Yes.
Remember when we were doing FAC2601, we were having the revaluation surplus and we record it as other comprehensive income. You'll remember that term.
Okay.
So when we record it as other comprehensive income, is the same as is the other components of the equity, like other comprehensive equity, like we have equity, which is our ordinary shareholders, and then the preference shares we do have. So what causes another thing as our other components of equity to be the revaluation surplus?
Okay, you said I must check on page?
I said page 228, the same page 228 that we are referring to. You wanted to know the 30,500. So I'm saying the 30,500 comes from the revaluation surplus on page 229 of statement of change in equity.
Okay.
Are you happy? Remember last week, if you
yeah, I'm happy now. I see it.
If you were in my class last week, I did recommend that if they ask you a question whereby they say draft all financial statement, the consolidations one, in order for you to ask them without scratching your head for a long time, you have to start as answering. You're gonna do your analysis of shareholders first. Then after analysis of shareholders, you're gonna draft the statement of profit and loss. Then after statement of profit and loss, you draft your statement of changes in equity. Then after changes in equity, then you draft your statement of financial position. But in terms of presentation, your financial position will be number 1, the profit and loss will be number 2, the equity will be number 3. But when you write, number 1 will be your profit and loss, 2 will be your equity, and then 3 will be your statement of financial position. Another one, we have a question with regard to this learning unit.
Okay, thank you.
It's either can be this example or it can be the whole learning unit as a whole, maybe number 9. Before we cross over to topic B, I don't know if it's topic B or it's topic 1, but it will be the cash flow. I assume that none have a question. Then we're gonna use the last hour for the cash flow. Let's turn our study guides into page 260. On page 260, we've got the statement of cash flow. So our assessment criteria, they say after studying this learning, you should be able to do 1, draft the statement of cash flow with a company notes for a company by means of IFRS. Draft the statement of cash flow with a company notes for a company using indirect method in accordance with IFRS. So it means the direct versus the indirect. Then the introduction, I'm not going to read more on that. I'll tell you the financial statement. The purpose of the presentation of the statement of cash flow is to have the logical presentation on the net cash flow from operating activities, net cash flow from investing, the financing, and the net cash and cash equivalent. So our net cash flow from operating activities, it will have mostly comprises of the cash receipts from customer, cash paid to supplier. We have the investment income, the interest paid, the income tax paid, the dividend paid, and the proceeds from the sale of assets through the profit and loss held for trading. If there were any assets that were held for trading, then when we record that profit, it's going to also affect our operating activities. Then we have the investing activities, which normally will be for the cash flows arising from the investment, either in the form of acquisition of the property, plant, and equipment and other non-current assets, or either in the form of the sales of those property, plant, and equipment and other non-current assets. Then the last portion will be the financing activities, which it will come as a result of the cash flow arising from the proceeds on issuing of the shares, the payments to the owners to acquire or redeem the entity's shares, the proceeds from the issuing of the debentures, the loan, the mortgage bonds, the current and the non-current borrowings, and the repayment of the amount borrowed. So when we pay the amount which we borrowed, they're gonna end up making the cash outflow. So on page 2264, they say the cash flow can be presented in the form of the cash flow from operating activities. You minus the cash applied in investing activities, your plus or your minus the cash inflow or outflow from the financing activities, and then represented by the equal sign, which it will be the net increase or the decrease in cash and cash equivalent. So if you did your cash flow correctly, your cash and cash equivalent should, the one on the cash flow should balance with the one given in your statement of financial position. So if they balance, then you can know that your cash flow is 100% correct. So remember, when you do the cash flow, the amount in brackets they will represent the outflow, and the one without the bracket they will represent the inflow. So it means the cash is coming in, it will be a plus. The cash is going out, it will be a minus in the form of brackets. So the framework given to draft the statement of cash flow is shown on page 265. So the one on page 265 is the direct method, and the one on page 266 is the indirect method. So when you do the required, when you answer the question, you have to check which method do they want you to draft your cash flow, the direct versus the indirect. So we proceed. Now we are given the information on page 267. They say, we will use the following example throughout the learning unit to illustrate the certain aspects of the cash flow information. The following balances appear in the books of Ross Limited for the year ended 30 June. We're given the 2006 and the 2005. So our 2005 will represent the opening, our 2006 will represent the closings. So we're given the asset section, we're given the equity and the liability section. Now we proceed further on page 268. We are given the statement of financial position, profit and loss, and other comprehensive income of Ross Limited for the year ended 30 June 2006. Revenue 500, cost of sale, gross profit, other income, administrative expenses, selling expenses, other costs, finance costs. Additional information. The long-term borrowing bears an interest at 12% per annum, payable in arrears, and was repaid in 31 December 2005. Interest did not qualify for capitalization. In December 2005, a piece of land that cost 15,000 was sold for its carrying amount and replaced with another piece of land. On 30 June 2006, the remaining land was revalued. There were only transactions in respect of the land and building for the current financial year. During the current year, a machine with a carrying amount of 51,000 was sold at a loss of 8,000 and replaced with a new machine with a cost of 62,000. The total depreciation on plant and machinery for the current financial year amount to 39,000. A motor vehicle with a cost price of 14,400, on which depreciation of 7,400 had already been written off, was traded in for 9,000 on a new vehicle that cost 35,000. No other machine or motor vehicle was sold during the current year, but one additional motor vehicle was purchased. The provision for tax for the current year was 15,000. This includes an under provision of 5.1 for the 2005 tax year. New shares were issued on 30 April 2006. On 31 December 2005, an interim ordinary dividend of 4 cents per share was declared and paid. Ordinary dividends of 6 cents per share were declared on 30 June 2006. The financial assets were sold at amortized cost on 1 July 2005. These shares were purchased without the intention of short-term profit taking as part of the business model. During the year, dividends to the value of 3,000 were received. Required to have the statement of cash flow for the year ended 30 June 2006. Now, they want to illustrate using the direct method. When you do the direct method, you're going to start with your cash receipts from the customer. So it means you'll be following the logic on page 265. So on page 265, they say cash flow from operating activities using direct method. We're going to start with the cash receipt from the customer. So your cash receipt from the customer, it will be drafted in the form of ledger, which on the balance brought down our trade receivable. In most cases, they increase on the debit side and they decrease on the credit side. So the balance brought down will be the 50,000, which is the balance on the beginning of the year, which it will be the one as per page 267. When you check your trade and other receivable on 2005, we have 50,000. So that will be the 1 January, the 1 July 2006 balance will be 50,000 as the balance, as the opening balance. The opening balance will be 50,000. Then we've got sales made during the year. The sales made during the year, when you check the page 267, you have 500,000, which is shown as, or it will be on page 268. The page 268 they gave the revenue. So the revenue straightforward is 500,000. So you're gonna take that revenue on page 268 and you put it as your sales, which is 500,000. So the 50,000 plus 500,000, they give you 550. So they gave you the balance. They said the balance carried down, which is the balance at the end of the year in respect of the trade and other receivable. The trade and other receivable balance at the end of the year is given as 37,400. So you record the 37,400 on the credit side because it's the balance at the end of the year. So you say you have 50,500, you will less the 37,400, then it's going to give you the balancing figure of 512,600. Any question up to so far? Any question? TK, Takalani? I can see you wanted to say something.
You still haven't started with the Excel, ne? Not showing anything yet, ne?
Yeah, it's just
Okay.
Excel plain. It's just the same example that I was dealing. I didn't write this ledger. Do you want me to write this ledger on Excel?
No, I'm just making sure that
Okay.
I'm not behind.
But do you understand this trade in other receivable, which it will represent the cash sales from the customer, cash received from customer? Do you understand it?
Yes.
Okay. Another one who doesn't understand, being silent, I will assume that you understand. Then we proceed further to the cash paid to suppliers. Going once, goes twice, done. Okay. Now we go to cash paid to supplier. Cash paid to supplier, and this one I can just do it in the form of ledger so that we understand it because it's a little bit tricky. Cash paid supplier in the form of T form. We're gonna have this debit side. We have the DR side, credit side. Then here you've got inventory. Initially, we've got a separate account as in inventory. Inventory, it increases on the debit. Debit, credit. Inventory, it increases here, it minuses here. Plus, then it minuses here. Then the prepaid is the asset. Prepaid, which is the asset, they plus here, they minus here. And then we have trade and other payables. Trade and other payables, which they plus here, and they minus here. So when you record all your balance brought down, they take the positive figure. Your balance brought down of the inventory and the prepaid, they will go with the debit. The balance brought down of the trade receivable, they will go with the credit. They take the positive, the plus signs. Where are the plus signs is where you're gonna be your balance brought down. And remember, the balance brought down will be the balances on at the end of the last year, or which will be the opening balance of the current year. So in respect of this question, all the balances of 30 June 2005, they will represent the openings, which will be the balances as the same as 1st July 2006. So instead of in case of the cash paid suppliers, since we're gonna record the inventory here, it will take the debit side because it increases on the debit side. So we're gonna have inventory plus and as shown in the balance from the page 267, the inventory was having a positive balance of 50,000. And then the prepaid, they had a balance of 2.6. So you're gonna have prepaid 0.6. And then we have, so since we open them, we also have to close. So when you close, they're gonna be on this side. So you close as their inventory. The balance carried down of the inventory will be on the credit side because its weight is to reduce. So the balance of carried down of the inventory, it will be 67,000, which is the closing balance, as shown in the page 267. The inventory balance is 67,000 at the end of the year. The prepaid balance at the end of the year is 500. And then we have the trade and other payables. The trade and other payables, they increase on the credit side. So their balance at the beginning will be 26. Their balance at the end will be on the debit side. Which will be 38,800. Now we have to fill whatever needs to be filled. So we're gonna go to the cost of sale. The cost of sale is gonna take this portion, cost of sale. The cost of sale is shown from the statement of financial of profit and loss is shown as 250,000. 250. And then administrative expenses. Admin expenses. The admin expenses is shown as, when you check the statement of profit and loss, the admin expenses is shown as the total of 78,200 plus 63,600, which is 141,800. But we know that the administrative expenses, they include the depreciation, and depreciation is regarded as not. Remember, when you are doing the cash flow using the direct method, you only account anything that is cash in your operating activities. You only focus on the cash items. So let me make it as a note here. Direct method. operating, which is we only focus on cash. So it means if it's a non-cash, it must be taken out. If a non-cash item, it be taken out. So in this case, our depreciation is a non-cash item. So depreciation need to be excluded from here. You can't include it. So taking into account, if we were given in the exam, they were gonna say administrative expenses is 141,800. They were not gonna show you this 78,200 plus 63,600. You have to calculate your depreciation alone, or how much was the depreciation for the current year. So in order to calculate that depreciation, we say we are calculating depreciation on our side. Depreciation calculation, we had the plant and machinery. They say is given. Let's read the adjustment and see if indeed it is given. The plant and machinery is found on adjustment number 3. On adjustment number 3, they said during the current financial year, a machine with a carry amount of 51,000 was sold at a loss of 8,000 and replaced with a new machine with a cost of 62. The total depreciation on plant and machinery for the current financial year is 39,000. So we have a plant and machinery is 39,000 given. You're happy there. Then we go to the one of the others, which it will be the one for motor vehicle. So motor vehicle. So on the motor vehicle, we don't know how much is the depreciation. So we have to calculate it. So the motor vehicle, we had there is a value of they say adjustment number 4. They say a motor vehicle with a cost price of 14,500 on which depreciation of 7.4 had already been written off was traded in for 9,000. So there's a motor vehicle with a depreciation of 7.4, but the 7.4 is already traded in. So once it's traded in, so it means it's going away. It's no longer forming part of us. So the motor vehicle accumulated depreciation at the end of the year is given as 27,200. So that is the depreciation at the end of the year. So meaning is the accumulated depreciation ACC dip at end is sitting on 27,200, which is given. But remember, if it's the at the end, here it will be end. At the end is sitting at 27,200, and at the beginning is sitting at 10,000. So what happened here in the middle? Something happened in the middle. So in order to arrive here, so when you say the 27,200 plus 10,000, so we've got 17,200. 17,200 is the depreciation. And then now, I tell you that there is a certain asset which was sold. So we're gonna say we have a 10,000. That's the accumulated depreciation at the beginning. Now there's an asset sold. So once the asset is sold, we minus the 7.4. So we say minus 7,400. So it means the accumulated depreciation remaining at the beginning of the year now is no longer 10,000. 10,000 minus 7,400. The 7,400 represent the asset sold because they said it was traded in the motor vehicle with cost price of 40,000, on which depreciation of 7.4 was already written off on it, has been traded in. So once you trade in, it means the asset is no longer with us, it's gone. So we're gonna say 10,000 minus 7,400. So we are left with 2,600. So it means our accumulated depreciation at the beginning is now sitting at 2.6. So the 2.6 at the end must be 27,200. So now we want to know what happened here. What is the depreciation here? So the 27,200 minus the 2,600. So we are left with 24,600. So the 24,600 is the depreciation happened during the year. Are we happy there? Mary?
I'm okay, sir. I'm with you.
Okay. Glenn Rose.
I'm okay,
She's
Minnie.
away. Oh, Tandeka.
I'm good. Thank you, sir.
Mulise.
I'm also good, thank you.
And then TK.
I'm good, thank you.
Okay, so since everyone is fine, then we're gonna say the depreciation to be taken out from our admin. Since our admin was sitting as it was sitting as 141,800. So we're gonna say the 141,800. Then we less the depreciation. So our depreciation is now sitting as 63,000 because it will be the 24,600, this one, plus the 39,000, which they give us the 63,600. So now you know how to calculate this 24,600. So we're gonna less this 63,000 from our admin. So it means now on our admin, we're gonna only left with 78,200. So in this case, I show it. Suppose we were not given that 78,200 plus 63,600. So here it means we're gonna say our admin. Okay, let me go back there. Our admin expenses now it will be sitting at 78,200. Then the selling expenses. The selling expenses is sitting as 87,400, which is given from page 268, 87,400. So when we do everything there, we add our site, which they give, this side is give us 50,900, and then this side it give us the 91,400. So it means our credit side is bigger than the debit side. Are you still seeing my Excel?
Yes, we can
Yes.
see it.
All right. So now we say, okay, since our credit is bigger than the debit, so it means the debit, they want to have the balancing figure. So we're gonna write the balancing figure, we're gonna call it bank, which will be a balancing figure. So we say this side of 509 100 be less the other side, which is equal the 91,400 minus 91,400. So it gives us the 417,700. So now these two sides will be equal. This is 5,900 and also this is 5,900. So it means this will be used as our cash paid to supplier, while this, the other one calculated on page 269, the 512 will be used as our cash received from customer. Then from there, it means according to the direct method, we have the two, which we have the cash received and cash paid. Then we can have the cash generated from operation. Then from there, we'll add the interest received, the interest paid, the dividend received, the dividend paid, and the tax paid. So according to this slide guide, let's see how did they work it things out. Did they proceed further with the direct method, or they calculated the other things? They had cash paid supplier, and then the cash generated from the operation. We obtain the amount by subtracting the cash paid to supplier and the cash receipts. Then they do the interest received, they do the dividend paid. So the interest received, dividend paid, and the normal tax, those they are applicable, whether direct or indirect method. We just have to have them. They are the normal things. So let's check the so if we go to page 271, we've got the 512 calculated as our cash receipts from a customer is the same as the one come from page 269. Then we got cash paid to supplier of 417 is the one coming from the page 270, the same as the one calculated in the form of ledger here. So when you say the 512 minus the 417, they give you the 94,900. So this is the direct method. So let's see how the indirect method will be done. In terms of the indirect method, is page 272. So on your page 272, you want to calculate how to arrive to 94,900, the cash generated from operation. So with the indirect method, you're gonna start with the profit before tax, because the other things that come after, they will be the same. The interest paid, the dividend received, the dividend paid, the tax paid, they will be the same, either both direct and indirect, they will just be the same. So now let's focus on the indirect method, calculating the cash generated from operation. You're gonna have profit before tax of the profit before tax is 10.5 as taken from the page 268. Then you have the depreciation. So here you're gonna do adjustment for non-cash. Everything that is non-cash, is either, if it's a minus, initially it's a minus, you're gonna add it. If it's a addition, now you're gonna minus it. So depreciation normally is a minus. So now we're gonna add it. So the depreciation of that 63,600 is a non-cash item. You have to add it back. The profit on sale of a non-current asset, we realize the profit. When we realize the profit is a plus, but in terms of the cash flow, we're gonna do it as a minus. So the profit on sale of a non-current asset, it came as a result of adjustment number 2, adjustment number 3. Let's see. I want that 2,000 as a profit. If there's anyone who see it, also assist me. It's just amount which is given. Profit of 2,000. During the year 51 sold loss. Motor vehicle 14. The cost price is 14.4. Depreciation is this. Okay. If you do the calculation on adjustment number 4, we're gonna have cost here of the asset. It's cost. It costs it costs 14,400. And then there is a depreciation written off. Depreciation. This is only adjustment number 4. That's vehicle. Vehicle traded in. Vehicle traded in. Depreciation. The depreciation on this vehicle is written off as 7,400. So when you say equal this minus this, they give you 7,000, right? We are happy here, ne? They give you 7,000, which is the carrying amount. So since the carry amount is 7,000, now we have a trade in. The trade in of asset is 9,000 because they say it had already been written off, then was traded in for 9,000 on a new vehicle. So when we trade the asset, they said, okay, this asset is now, we're not gonna say it's worth 7,000. Instead, we will say it's worth 9,000. It means our 9,000 minus 7,000, it would give us the profit. So this is a profit as a result of trading in the asset. Profit as a result of trading the asset. So this profit of 9,000, so this profit of 2,000, it will be recorded in your indirect method. On your indirect method, they will say profit on sale of non-current asset is 2,000. So that 2,000, they put it on minus because I said everything that is plus, you're gonna do it minus. Everything that is minus, you're gonna do it plus. So this is a profit. Normally, the profit must be a plus. So, but when you record the indirect method, you're gonna show this profit as a minus. So the profit on sale of a non-current asset is minus. Are we all happy there? Takalani?
Yes.
Glenn?
Yes, thank you.
Tandaka?
Yes, Mr. Molepo.
Mary?
Yes, thank you.
And then Mudise.
Yes, thank you.
Okay, so since we all agree that this is a profit, so the profit will be recorded as a minus when we are doing the indirect method, so it will be minus 2,000. So the loss on sale of non-current asset, that one is given. Is given on adjustment number 3. They say during the current financial year, a machine with a carry amount of 15,000 was sold at a loss of 8,000. So it's a loss. A loss is a minus when we are doing our books. But for the purpose of doing the indirect method of cash flow, we're gonna add it back. So we add that 8,000 back. Then we have the interest expense. The interest expense, it came as a result of the finance cost. The finance cost is sitting at 7.3 from the statement of profit and loss on page 268. Finance cost is 7,300. So it's an expense, but now we're gonna record it as an income. So we do it as a positive sign. Then we have the investment income. The investment income of 3,000 will come as a result of $7.3 10.3 16, 27, 18, 18. Okay, let me see, where does the investment income come from? The investment income from the, let's see.
Isn't it adjustment number 11?
Adjustment number 11. During the year, dividend to the value of 3,000 were received. Yes, you are right. So that adjustment number 11 is the dividend that we received. So it's an investment. So it was an income, but now we have to subtract it. So our cash from the operating up to so far, we have 84,400. So that 84,400, now we have to account for the change in working capital. The change in working capital will come as a result of the inventory, trade and other receivable, prepaid expenses, and trade and other payables. This only 4, nothing else. So you check their opening balance versus their closing balance. So if the opening balance was 50,000 and the closing balance is 67, so it means now the cash flow increased, because initially the inventory, let's check. The inventory opening balance, it was 50,000. Now our inventory closing is 67. So it means we purchased more inventory. So since we purchased more inventory, it means the cash is going out. So the cash went out to the value of 17,000. We all happy, right? So it means our 17,000 will be minus. So here we don't use the transition. We don't use the inverse. We don't say it's supposed to be minus, now it's going to be plus. We just take it straightforward. So the change in working capital, we take it straight the way it is. But those one, the adjustment before, the adjustment is a result after profit before tax, is the one which we are using the inverse. So our cash, our inventory, it was 50,000, but now it's sitting at 67. So it means our inventory increased. So as a result of inventory increasing, it means our cash is going out. We are buying more inventory. So since we are buying more inventory, the cash is going out to the value of 17,000. Tick. Decrease in trade and receivable. Our trade receivable in the beginning of the year, it was sitting as 50,000, but now it's sitting at 37,400. So it means people, they are no longer purchasing on credit in this case. So since people, they are no longer purchasing on credit, so it means our cash is coming in. Because as a result of the trade, the higher the trade receivable, so it means the cash is not coming in. So if the trade receivable is going down, so it means our cash is coming in because people, they are paying. So decrease in trade and receivable represent an inflow, because people, it means now they are paying the color to Tabona. So since people, they are paying their amount which they owe, so it means we are receiving cash of 12.6. The prepaid expenses. We had the prepaid expenses of 2.6 at the beginning, but now our prepaid expenses is sitting at 500. So it means we are not paying too much now. Since we are not paying too much, so it means our cash inflow is coming in, so we can reserve cash. So it means our decrease in prepaid expense, they're gonna result in inflow of cash of 2.1. Because we used to pay too much, we are no longer paying, so we have a inflow of 2.1. Increase in trade and other payables. The trade and other payables, we had the trade and other payables balance at the opening of 26,000, but now it's sitting on 38,800. So it means we are not paying our liabilities. So since we are not paying our liabilities, it means we still reserve cash for our side. So since the cash is reserved, so it realized an inflow of 12.8. So we record them the way they ask: the outflow of inventory, the inflow of receivable, the inflow of expenses prepaid, the inflow of trade and other payables. So they give us the change in working capital of 10,500. So you're gonna say the 84,400 plus the 10,500, then it gives you the 94,900. So this 94,900 as cash generated from operation is the same as the one of the direct method on page. Where was the direct method? On page 271, the 94,900. So it means now our direct method, they balance both the direct and the indirect. They have the same figure of 94,900. Then after that, we can go to the thing. We can go to the changes in operations. So the operation, we have the interest received, the interest paid, the dividend received, and the dividend paid. Just hold on for a second. Continue. So are we clear up to so far with regard to the cash generated from operations, both direct and indirect? Takalani?
Yes, sir.
Would you say?
Yeah, we clear, sir.
Glenn?
Yes, thank you, Mynheer.
And Tandeka?
Clear so far, thank you.
Okay, so now we can go to the interest paid, the dividend received, the dividend paid, and the tax paid. How are we calculating them? So those are shown in page 270 to page 271. The interest paid, the dividend received, and the paid and normal tax paid. The company normally make a payment of SARS and the suppliers of funds and cash generated by operating activities. We should therefore disclose interest paid as well as tax and the dividends paid during a year separately from the cash generated by operating activities. So the dividend paid, so we have the amount, unpaid amount at the beginning of the year. So that 26,000 unpaid amount at the beginning of the year. Let's see, in respect of the dividend paid. The dividend page. Would you say please mute in the meantime?
Sorry.
The dividend page. Check capital revaluation retained earnings debenture text. The ordinary dividend paid, it was dash. If you can see on that in 2005, it was dash. So you're gonna say the dividend paid is dash for 2005, and then amount debited against income. So that will be the dividend declared as per statement of dividend declared on financial position. It will be shown in terms of an example, adjustment. They said on adjustment number 9, ordinary dividend of 5 cents per share was declared. So you're gonna say the 1 of 5 cents declared versus the interim. So the interim was 4 cents. So you're gonna say 4 cents on December multiplied by the share issued. The total shares issued, it was the 280 and the 250. Let's see. So they were paid by who? They don't mention. So let's say 4 cents times. Where's my calculator? I'll say the 280 plus 250. Multiplied by 0.0. It's 21,200. So those are the one for 4 cents. 4 cents, 1,200. And then the one for 6 cents, which are the final. The final one is 280 plus 250, which should give us the 530. 530, 1, 2, 3, multiplied by 0.1, 800, then 80, 1, 4 is 21, 200, and then 6. Okay. Check there underneath. You see there's an ordinary dividend. On the dividend paid, there is a calculation share shown as ordinary dividends on page 271. They said interim dividends is 250 times 4 cents, and then the final is 280 times 4 cents. So the final is the 280, the interim is the 250. So when you add them all together, they give you 26,800. Then you said amount debited against the income, which is the amount paid as a result of the ordinary dividend. It will be 26,800. Then an amount paid at the end of the period, which is that with the closing balance. The closing balance of 16,800 with respect of the dividend paid, as shown from the statement of financial position on page 267. Ordinary dividend payable is 16,800. So you're gonna say the balance plus 26,800 minus 16,800, then it give you that figure. That figure is the one to be used as dividend paid. So the amount at the beginning, it must be a positive figure. For in case if you are given, it will be a positive figure plus the 26,800 minus 16,800. Then whatever amount that you get, it's gonna represent your dividend paid. The same you're gonna do with the tax paid. The tax paid, it will be unpaid amount at the beginning of the year, which is the amount shown as tax on page 267. On page 267, when you say tax payable, it's for the 6,600. So you say for the 6,600 as the tax payable, then you add with amount shown in adjustment number 6. The amount shown in adjustment number 6 as the provision for the tax, which was the provision was 15,000. And they said this provision includes the 5.1 of the under provision. So if they say 5.1 was not included, you're gonna say the current year plus the under provision not, which was excluded. But in this case, because it was already included, so there is no need for you to take it back into account. You just use the final amount of 15,000. Then you will say the 46,600 plus the 15,000, then less the amount at the end, which the amount at the end is 23,300, the one shown as tax payable at the end of the year. So you less it, then you get the 38,300. Then the 38,300, when you which is a positive figure, then you transfer it into your tax page as page 271. Then you're gonna have your cash generated from operation less interest less, and then you add the dividend received, and then you less the dividend paid, then you less the tax paid, then they will give you the 44,300. That will be the cash operating activities. Then from there, you're gonna go to the investing side. So the investing will be shown in page 274. The 274 will be investing. The 275 will be the financing. And then the last portion, it will be, hold on, I want to check something. The last portion should be the one of calculating the cash, calculating the net increase on cash equivalent. So which it will be the figure, it will be the figure you got on page 271 plus the figure you got on page 275 plus the figure you got on page 275 at the top. The 35,800 plus the 6,200 and plus the 44,300 on page 271. You add whatever is plus, you minus whatever is minus. Then they will give you a net cash equivalence at the beginning of the year. Then you have the one at the end, which must be balancing figure from your statement of financial position as shown. If they balances, then it means your cash flow balances. So we are only left with 3 minutes. So I will advise you to go and do the page 275. 274, cash flow from investing activities, which is the both methods, they are the same. And also do cash flow from the financing activities. They're also the same with the both methods. And then do your last part, which the last part will be the one on page 275. If you see, they say net effect of the first 3 sections is from operating activities is 44,300. We already done it. You're only left to calculate the investing and the financing. So once you got the investing, the financing, then you're gonna do your net increase in cash and cash, which will be the 2.3. So that 2.3, somehow it must link with the bank overdraft. You see, the bank overdraft, it was sitting as minus. That's why they say the cash and cash equivalents at the beginning of the year is minus 300. So the minus 300 is their bank overdraft, because if it was a positive figure, they're gonna add it. But they said minus because it's the bank overdraft. So when you say 2.3 minus the bank overdraft, it gives you the 2,000. So that 2,000, it will be the cash and cash equivalents at the end of the year. If you check the cash and cash equivalents at the end of the year, is represented by the bank. That's why you have the bank as 2,000 on the balancing figure. So this balancing figure of 2,000, it must be the same as your bank at the end of the year. If they are the same, so it means your cash flow is balancing. So it means your cash flow is 100% correct. Anyone who have the question up to so far, the only thing left is to do the investing and the financing, and then you do the balances at the bottom of the page 275. Anyone have a question with regard to the cash flow? The financing, the investing, they are just the same, both methods. The only thing is to understand the indirect versus the direct on the operating section. Takalani, any question from you?
No questions, sir.
Glen Rose, any question from you?
No questions, Menier. I do have an idea, a little bit of what's happening. So you just need practice.
Okay.
Thank you.
And then Mulise.
Just a quick question. So these two methods, direct and indirect, the only difference is the first part, and the rest of the statement is would be the same for both.
Yes.
Okay. All right. Yeah, I'm just trying to grasp the concept. But should be fine. I'll have to do some work during the week, but I'm good. Thanks.
Okay. Mary?
Fine, sir. Thank you.
Okay, the last one, Tandega.
I'm gonna have to redo it again, Mr. Molepo. And should I have any questions, I'll I'll send you questions offline.
Okay. All
Thank
right.
you.
Okay, so I will advise you to tackle again the cash flow. And after the cash flow, then we'll go back. Next week, we ask the question where you didn't understand anything. Then from there, we tackle the question. So now I will say you have a lot of work. A lot of work is first you have to tackle your understand this cash flow, and then again you do a question from the tutorial letter, which the question that we'll be doing, it will be, let me go back to my thing. Just hold on. Yes, you have to. I'm gonna share something. Just hold on. Share. Share. Do you see this thing? The proposed timetable thing.
Yes.
Okay.
Yes,
So today we're here on the 9th, done. Now on the 16th, you will be required to do a question, which is question 18. You have to do question 18. So we're gonna do it together in the class. However, it will be more beneficial to do it on your side first, where you don't get it. And then when we take it in the class, then you have an idea of where did you get wrong. That will be next week. And then, so next week will be the brush up of the cash flow. Just maybe it can be 15 minutes or so. Then the entire 1 hour, 45 minutes will go for the question 18. And then that other week, it will be the question 21 and question 27. The other one is cash flow. The other one is just the consolidations. Yeah. I have everyone have a clear understanding of what left for the remaining 2 weekends. If there's any question you can ask. If there's no question, then I will assume that is the end of the class. Mr. Francis?
Yes, Mr. Molepo.
You can stop the recordings.
We'll do that.
Okay. So this link, it will be the same link for next week, right?